Hi guys, welcome back to the Joyful Investors channel. As we enter in the new year, are you thinking how you can invest smarter in 2023? Here are 5 tips that we have compiled for you. The first tip is to stay humble and diversify. How you can do so is to first acknowledge that you do not know any company too much where it is enough for you to risk too much. Even if you think you have already done a lot of research, Ken Fisher often calls the stock market the great humiliator. Bear markets like the ones that we are having right now can cause a lot of emotional damage to many investors for a long time. The way to stay humble is to not over-concentrate your positions until you have 3 or less positions, because anything can happen to a company. Many investors have taken a dent in their portfolio because they made outsized bets on just 1 or 2 positions. Of course, we have renowned investors like Monish Pabrai and many others who are known to have only a few positions at any point in time. But sometimes they can do so because they may know things that we do not know of. Most of us do not have the informational age, and we are better off by being more diversified. Hence, ideally, most retail investors should seek to have positions in at least 10 stocks or more. And no single holding should make up more than 25% of your entire portfolio, even if you think that you understand this company really well. For us, the Joyful investors, we tend to have about 15 to 20 positions at any point in time, spread across the 3 markets that we invest in: the US market, China, and Singapore. So you see, sometimes doing well is a curse, whether in life or in our career or in the stock markets. It starts seducing us into thinking that we are invincible and we start making bigger bets. When that happens, we can remind ourselves that we are not as great as we think. And probably there was some element of luck as well. So take a look to see if it's time to take some profits from an overextended run in the markets and raise cash, especially in a time where you think you need it less. The second tip is don't be fooled by averages. It's probably a well-known fact that the S&P 500 delivers an average annual return of 10% based on historical performance. However, there are good years and there are bad years. Most beginners are sold to this fact, thinking that their investments can compound at 10% each year generally. But a lot actually depends on whether you have a bull market or a bear market in your initial years of investing. If you happen to invest in bear markets, then worse than average performance is definitely possible in the earlier years. And one reason why some of us are so afraid of the bear markets is because if, let's say, your portfolio is down by 50% from 10k to 5k, then to break even, we need 100% return. And since the US markets are known to deliver 10% a year, you may think that you need close to 10 years with a compounded effect to make your money back, but that's not true. Bull market returns are way above average, especially after a big bear market, in order to make up for those steep losses. Just like bear markets can come crashing down hard, stock prices can really fly in a bull market. So the point is to be able to see everything in entirety so that you do not get too upset during a bear market, nor be too overconfident during bull markets. Both good and bad times don't last forever. And you should also be pleased to know that bull markets generally last much longer than bear markets. So there is really no need to be overly upset, even though you are in a bear market. And that's how you can continue to invest joyfully with the long-term picture in mind. The third tip is don't replace what you need with what you want. Always ensure that you only invest the cash that you have and can set aside for the long term. Neither should you leverage your positions, because when you do so, when the market is down by 5%, you could be down by 10%. That's how scary it can be. Over the years, we have heard of people who have not been able to pay for their housing loan, their renovation expenses, or school fees because they assumed that by the time the money is needed, a tidy profit would have been made from the stock markets. It might not really improve your life that much to earn that 10% to 30% return, but it may mean the world to you when you no longer have the money to pay for your housing or for your bank loan, which can result in financial ruin. Let's not mention specific examples here, but by now you probably have seen that many have lost their life savings and emergency funds because they simply risk all that they need for something that they could have done without. Only invest with the money that you can hold for the long term. investments in equities need to have strong holding power. There are many investors who lost money in the stock markets not because they bought the wrong stocks, but because they had weak hands due to their financial circumstances. Weak hands would mean that because the money meant everything for them, it was easy for them to liquidate their shares due to fear of further losses. The fourth tip, don't compare your investment returns with others. As investors, naturally we're inclined to compare our investment returns. Or maybe it runs in the blood of Singaporeans to compare. Returns in itself are meaningless without the context in which it took place, which includes the risk or the volatilities associated with it. You may have once envied the investment returns of investors who had astronomical returns in a single stock. But for some of these investors who had incredible returns in that period of time, they could well suffer from massive losses when the tide is out. Stock markets are known to perform differently at different points in time. Hence, we also do not sneer at the performance of our fellow investors in an underperforming market, because we may have it worse when the market that we invest in underperforms in the future. Investment returns could also be a direct result of the investment objective. An example is for investors who are invested in our local Singapore markets, in particular the Singapore REITs. They are probably in more so for the dividends. Hence, 4% to 5% yield is reasonable, while they just leave their money idling there. For capital appreciation, perhaps better markets to look at would be the US markets or the China markets, which may offer better upside generally. So know your own game plan and investment objective and stick to it. In short, different strokes for different folks. The last tip that we have for you is to level up your investment knowledge. Eventually, you would want to get smarter with money and come to realize that money management and investing is something that is going to stay with you for a long time, or rather, as long as you live. It pays well to learn more about it because nothing is free in this world. When we are more grounded in our knowledge, we can become less problem-minded but more opportunity-minded as an investor. No markets are good or bad. It is your thinking that makes it so. And as you progress, you will come to understand that the market is less about the bookish theoretical knowledge, but more so about the practical application in the stock markets and the investor's psychology and behavior. In the financial markets, it also helps to be an all-rounder, just like in cricketing. If you have more tools at your disposal, just like a cricketer can play different strokes based on the situation, you can then maneuver more flexibly as per the mood of the market. The options market, for example, is a great way when it comes to income generation and risk mitigation for investors if they learn how to do it correctly. And these are just some things that financial advisory may have no interest in advocating because there is no good money to be made. They are in the asset gathering business and they will much rather do so in the simplest way of dollar cost averaging via regular top-ups. And they will often have you thinking that buying an ETF or a unit trust is simply the best thing rather than doing fundamental analysis to pick individual stocks, and that timing the market is futile or that technical analysis is not purposeful. Before you get us wrong, we are not criticizing them, and we are also not saying that they are a bad choice for investors. I just hope to bring forth the idea that as investors, we have to decide for ourselves which is more suitable for our individual situation. If you are totally new to investing and you'd like to get something going with a total hands-off approach, then it is definitely a viable path to seek advisory service for a fee. On the other hand, if you do not wish to be paying a recurring fee for the rest of your life because you see investing as a long-term endeavor, then you may consider taking the time to learn more about how to become a better and an independent investor. And that's where you can start learning through bite-sized investing contents, just like the ones that we produce over here on our YouTube channel and our TikTok channel. From time to time, we also keep you abreast with the latest market developments and our investing insights through our Telegram channel and Zoom sharing sessions. All these are free resources for you to get started on your investing journey and to make better decisions in the markets. For those of you who wish to take further action to learn more, we are also free to join our upcoming workshops at a very nominal fee. The link is in the description below. So if this video has helped you, do smash the like button and share this video out so that more investors like yourself can get to know more about investing and how to invest joyfully in the markets. So let's see how the markets will unfold in 2023, and I'll see you again.